The imminent reopening of the U.S. government is not merely a bureaucratic resolution. It is the triggering mechanism for a direct and substantial macroeconomic event with profound implications for financial markets, particularly the cryptocurrency sector. To understand its potential impact, we must move beyond the headline of government reopens and analyze the precise mechanical flow of capital that this action unleashes. The core catalyst is the disbursement of back pay to hundreds of thousands of federal employees and contractors who have been furloughed or working without pay for the duration of the shutdown. This represents not a trickle, but a sudden, synchronized injection of liquidity, a tidal wave of previously withheld capital into the bank accounts of a vast demographic. The psychological and behavioral impact of this injection cannot be overstated. For weeks, a significant segment of the workforce has been operating under financial constraint, delaying discretionary spending and tightening budgets in the face of uncertainty. The receipt of accumulated back pay transforms their financial posture instantaneously. It creates a pent-up demand effect, not just for consumer goods, but for financial asset allocation. A portion of this population, now made whole and potentially feeling the need to catch up or seek higher yielding opportunities to compensate for lost time, will look beyond traditional saving. This is where the digital asset market enters the frame. Cryptocurrency, particularly Bitcoin, has established itself in the modern portfolio as a non-correlated high-growth potential asset class. It is specifically attractive to a tech-savvy, digitally native demographic that overlaps significantly with a modern workforce. The narrative of cryptocurrency as digital gold or a hedge against systemic friction resonates powerfully with individuals who have just experienced a direct personal consequence of governmental dysfunction. The act of the shutdown itself can be a radicalizing of financial philosophy, pushing people to explore decentralized alternatives to a system that has just demonstrated its fragility. Therefore, this back pay is not inert capital. It is smart money in the sense that it is hitting accounts at a moment of unique recipient receptivity, even if only a single-digit percentage of this aggregate sum, which amounts to billions of dollars, is allocated to crypto assets. The market impact would be significant. The crypto market's relative liquidity, while growing, is still magnitude smaller than traditional equity or bond markets. A concentrated inflow of this nature can produce disproportionate upward price pressure, creating a self-fulfilling momentum cycle. This phenomenon operates through a clear transmission mechanism. The injection, billions in back pay are electronically deposited. The allocation decision, recipients now with surplus liquidity assess their options. For some, this includes rebalancing investment portfolios. The on-ramp action, funds are moved from traditional banks to cryptocurrency exchanges via linked accounts, a process that is now streamlined and familiar to millions. The market impact: buy orders are executed, absorbing sell-side order book depth and pushing spot prices upward on major trading pairs. The sentiment amplification: rising prices generate positive media coverage and social media discussion, attracting further attention, ancillary capital from retail and institutional observers, magnifying the initial effect. Furthermore, this event is temporally concentrated. Unlike a stimulus check rollout over weeks, this is a near simultaneous release. The market will not have weeks to gradually price in this new demand. It will face it over a period of days. This compression of the buying timeline exacerbates volatility and can lead to explosive, headline-grabbing moves that break the market out of prevailing consolidation patterns. In essence, the reopening is the match, the back pay is the fuel, and the unique psychological profile of the recipients combining financial catch-up mentality with a potentially renewed skepticism of traditional systems creates the oxygen. When these three elements combine, the conditions for a powerful, liquidity-driven rally are firmly in place. This is not speculative conjecture about future policy. It is the analysis of a tangible, imminent transfer of capital from government coffers to private hands and the statistically likely paths a portion of that capital will take. For the crypto market, this isn't abstract macroeconomics. It is the sound of a starting gun, signaling the beginning of a race for allocation that could define its price trajectory for the remainder of the year. The liquidity catalyst is immediate, measurable, and already in motion. The only remaining variable is the scale of its market impact. The resumption of U.S. government operations will do more than unlock paychecks. It will unlock a deluge of withheld economic data. For the duration of the shutdown, key agencies like the Bureau of Labor Statistics, BLS, and the Bureau of Economic Analysis, B, were shuttered or operating with skeleton crews, resulting in comprehensive and unprecedented data blackout. Reports on employment, inflation, CPI, retail sales, housing starts, and GDP, the very metrics that form the lifeblood of modern financial analysis and Federal Reserve policy, have been frozen in time. This absence has created a unique and perilous market condition, a vacuum of information where sentiment and momentum have been forced to operate in the dark. When the government reopens, this vacuum will not be filled with a gentle trickle of updates. The metaphorical dam holding back this data will burst, and the market will face a sudden, overwhelming flood of economic indicators, all released in a compressed, chaotic time frame. This data bomb presents a dual-edged sword of risk and opportunity. On one hand, the market hates uncertainty. For over a month, traders and algorithms have been navigating without fundamental bearings. The sudden return of data creates a massive recalibration event. Each report will carry the weight of 6 to 7 weeks of unmeasured economic activity, making it inherently volatile and potentially extreme. A single consumer price index (CPI) print that reflects the compounded price changes of a month and a half could show a shockingly high or deflationary number, not representative of a true monthly trend, but of an anomalous period. The initial market reaction to such extreme prints will likely be knee-jerk and exaggerate. Algorithms programmed to trade on data releases will react to the headline number with unprecedented force, potentially triggering violent swings in bonds, equities, and, critically, crypto, which has become increasingly sensitive to macro data as institutional adoption grows. For the crypto market, this presents a specific acute risk. Digital assets remain a high beta risk-on asset class. In a traditional risk-off event sparked by a hot inflation print, capital can flee from crypto towards the perceived safety of the US dollar or treasuries at lightning speed. The initial shock of the data dump could therefore catalyze a sharp, panic-driven sell-off, the final shakeout mentioned in our analysis. This is the immediate danger. However, on the other side of that danger lies immense opportunity. Volatility is not merely risk. It is the raw material of profit for the prepared. The chaos induced by the data dump will create massive price dislocations and inefficiency. For the disciplined investor, sharp sell-offs driven by macro data panic offer prime accumulation opportunities in fundamentally sound assets. As distinguishing between a liquidity-driven panic and a true fundamental breakdown. Herein lies the strategic insight. Much of this data will be viewed as retroactive and potentially distorted. Astute market participants, central bankers, and serious analysts will immediately discount the absolute values of these catch-up reports. They will understand that a jobs number encompassing 6 weeks is a statistical anomaly, not a new trend. The true value for traders will not be in the headline number itself, but in the market's reaction to the headline number. We will be watching to see if the sell-off is deep but brief, suggesting algorithmic non-fundamental selling, or if it sustains and leads to a structural breakdown, suggesting a genuine repricing of risk. Furthermore, this event will provide a crucial compressed snapshot of economic momentum. While individual reports may be noisy, the collective portrait painted by the data dump, the direction of employment, consumer prices, and spending across this period will offer an invaluable, if messy, diagnostic of the underlying economy's health as it enters the critical year-end period. For crypto, which is betting on a future of technological transformation and monetary divergence, understanding this underlying health is paramount. A data dump that reveals surprising economic resilience could bolster the case for higher for longer interest rates, a headwind. Conversely, data that shows clear cooling could accelerate the timeline for Federal Reserve pivots, a powerful tailwind. Thus, the hidden volatility trigger is more than a short-term shock. It is a catalyst for a fundamental repricing event based on long-withheld truth. It will separate reactive algorithms from strategic thinkers. The initial wave of volatility will be dangerous, a white-knuckle ride for all markets. But in its wake, it will leave a clearer picture of reality and, inevitably, fresh trends. For crypto, navigating this transition successfully, potentially using the fear-induced dip as an entry, could position investors perfectly for the next sustained move. The data dam is breaking. The flood is coming. And in that flood, the seeds of the next major trend will be sown. We are witnessing a critical convergence in the macroeconomic landscape, where the foundational assumptions guiding capital allocation for the past 2 years are being actively dismantled. This shift is not a vague forecast. It is an observable pivot occurring within the most influential financial institution in the world, the U.S. Federal Reserve, coinciding with a classic market sentiment extreme. This confluence creates a rare and powerful setup for a major asset repricing, with cryptocurrency positioned to be a primary beneficiary. Let's dissect the first element, the dovish descent. The narrative of higher for longer interest rates, which has acted as a persistent gravitational weight on speculative and growth-oriented assets like crypto. The significant development is the emergence of multiple Federal Reserve governors publicly advocating for a substantial 50 basis point rate cut at the December meeting. This is not a lone voice crying in the wilderness. It is a growing chorus of dissent from within the temple of monetary policy itself. Historically, such public divergences from the chair's perceived stance are precursors to a broader policy. Governors do not typically stake their reputations on bold, public calls for aggressive easing unless they sense both a fundamental economic necessity and a shifting consensus behind the scenes. This move signals a profound philosophical change. It is an admission that the fight against inflation has entered a new phase, one where the risks of over-tightening and triggering a recession now potentially outweigh the risks of persistent inflation. For markets, the implication is size. Interest rates are the risk-free rate of return, the baseline against which all other investments are judged. Lowering this baseline fundamentally recalibrates valuation models. Assets characterized by future cash flows and growth potential, technology stocks, innovative ventures, and particularly cryptocurrencies, see their discounted present value increase as the rate used to discount those future expectations falls. Furthermore, lower interest rates reduce the attractiveness of yield-bearing safe assets like treasury bonds, pushing the enormous pool of sideline capital held in money market funds and short-term instruments to seek higher returns elsewhere. This is the search for yield, and it invariably flows into riskier, more volatile markets. Now, layer on the second element, the sentiment extreme. While this tectonic policy shift begins, market sentiment in the cryptocurrency space, as measured by indices like the Crypto Fear and Greed Index, has plunged back into extreme fear territory. This is not a casual dip into pessimism. It is a reading that historically aligns with local price bottoms and significant buying opportunities. This sentiment reading is a direct reflection of the pain felt by recent retracements, the exhaustion of bulls, and the pervasive narrative of stagnation or further decline. It is the point where the last of the weak hands capitulate. Here lies the powerful, almost textbook contrarian setup. A fundamental positive catalyst, the Fed's dovish pivot, is emerging precisely when market psychology is at its most negative. This is the optimal condition for a major rally. When good news hits a depressed and disbelieving market, the initial reaction is often skepticism. It's a dead cat bounce. But as the evidence of the shift accumulates further dovish comment supportive data, the realization dawns that the fundamental landscape has changed while prices have not yet adjusted. This creates a violent upward recalibration as fear turns to greed, skepticism turns to FOMO, fear of missing out, and sideline capital floods in to chase the new trend. The everything rally thesis proposed by major bank analysts fits perfectly within this framework. It is a prediction that this macro shift will lift all risk assets, but with a crucial nuance. The most beaten down, high beta assets often see the most explosive percentage gains in such a phase. Cryptocurrency, as the archetypal high beta sentiment-driven asset class that has endured a prolonged period of fear and consolidation, is therefore not just a participant in this potential rally. It is a prime candidate to lead it in terms of relative performance. This confluence is more than just a bullish indicator. It is a roadmap for market mechanics. The Fed's evolving stance provides the fundamental fuel, the cheaper capital, and the renewed appetite for risk. The extreme fear sentiment provides the combustible material, an oversold market with minimal speculative excess, ready to ignite. When these two elements meet, the resulting move is not linear or gentle. It is characterized by sharp, volatile updrafts that leave latecomers behind. Therefore, this macro shift is the central narrative of the coming quarter. It overrides short-term technical resistance and negative headlines because it changes the very cost of capital and the strategic imperative for institutional portfolios. For cryptocurrency, a sector born in the era of near-zero interest rates and which thrived in that environment, the return of a dovish Fed is not merely supportive. It is a return to its native habitat. The combination of this policy pivot with deeply negative sentiment creates a historic asymmetry. The potential upside, given the compressed sentiment and high volatility, far outweighs the near-term downside risk for those with a strategic time frame. The stage is set not for a mere bounce, but for a fundamental re-rating. While the political theater of stalled legislation and government shutdowns dominates headlines, a quieter, more powerful narrative is unfolding beneath the surface. The relentless, accelerating pace of real-world adoption and technological innovation within the crypto ecosystem. This momentum operates independently of regulatory gridlock. In fact, it often thrives in the interstices of uncertainty, building tangible utility and economic gravity that will ultimately force the hand of lawmakers. This is not speculative hype. It is observable progress across three critical vectors: institutional infrastructure, core protocol evolution, and novel financial primitives. Together, they form an unstoppable engine driving fundamental value, irrespective of short-term price fluctuations. First, examine the institutional infrastructure being deployed. The announcement that JP Morgan is enabling swaps for its JPM coin on a public blockchain like Base is a watershed moment. This is not a pilot program or a research paper. It is an operational step by the world's most systemically important bank to utilize public blockchain infrastructure for core treasury functions. It signals a shift from the private, permissioned blockchain experiments of the past decade toward an acceptance of public networks for their settlement, finality, transparency, and interoperability. While questions about fee capture and competitive dynamics remain, the larger story is one of validation and entanglement. When a bank of JP Morgan's stature begins moving real value on-chain, it does two things. It bestows an immense degree of legitimacy upon the underlying technology, and it creates a tangible, irrevocable link between the trillion-dollar flows of traditional finance, TradFi, and the crypto economy. This is a one-way door. The infrastructure built, the teams trained, and the efficiencies discovered will not be uninvented. It represents a permanent deepening of liquidity and a hardening of the crypto market's foundation. Simultaneously, we are witnessing profound core protocol evolution. Upcoming Fusaka upgrade is a prime example. Following the successful transition to proof of stake, the merge, Ethereum's development roadmap is focused on scaling and user experience. Fusaka's improvements are not cosmetic. They are deep technical enhancements aimed at increasing network efficiency, reducing costs for developers, and improving the overall performance of the ecosystem. To view this merely as a potential price catalyst is to miss the point. Each successful upgrade strengthens Ethereum's core value proposition as a global programmable settlement layer. It increases its competitive moat against rival chains and solidifies its position as the foundational platform upon which the vast majority of decentralized applications, stablecoins, and institutional projects are built. The market's historical price reaction to previous upgrades is not superstition. It is a rational recognition of a de-risking event and a bet on the compounded future utility these improvements unlock. This is innovation in service of utility, which in turn creates lasting economic value. Third, the frontier of novel financial primitives continues to expand rapidly. The launch of a native stablecoin on the Sui network is a case study in ecosystem maturation. A blockchain's ability to support a robust native stablecoin is a key metric of its economic viability and developer traction. It moves the chain from being a speculative venue for its own token to a functional environment where real commerce and DeFi can occur with minimized volatility risk. This stablecoin race is a critical, underreported battleground. Distribution and yield incentives, as noted, are the weapons. Networks are competing not on hype, but on which can offer users and developers the most seamless, rewarding, and secure environment for their capital. This is hyper-competitive capitalism playing out in the digital realm, and it drives relentless improvement in user experience, security, and yield generation. The crucial synthesis of these three vectors reveals the core truth. The crypto industry is transitioning from a speculative asset class to a functional, parallel financial system. Regulation, while important for mainstream clarity and consumer protection, is increasingly chasing a moving target. The Senate-stalled market structure bill with its bracketed empty sections perfectly illustrates this gap. The technology and its applications are evolving faster than the bureaucratic process can codify rules for them. This dynamic creates a powerful investment thesis. One invests not merely based on what politicians might say, but on what engineers have built and what institutions are already using. The value accrual in this environment shifts from pure monetary speculation to capturing the growth of underlying economic activity, the fees from swaps, the yield from staking, the rent from virtual real estate in metaverses, the gas consumed by smart contracts. This is a more complex but ultimately more durable value proposition. Therefore, the acceleration of adoption and innovation acts as a powerful, self-sustaining counterweight to regulatory and macro uncertainty. Every institutional on-ramp built, every protocol upgrade completed, and every new stablecoin launched increases the system's overall resilience, utility, and gravitational pull. It embeds cryptocurrency deeper into the fabric of global finance. This is the unstoppable engine. While the winds of policy and sentiment may cause the ship to rock, this engine ensures it continues moving forward, building the infrastructure of the next financial system, one block, one upgrade, and one institutional partnership at a time. The train has left the station, and it is accelerating, regardless of who is still debating the schedule at the terminal.